hopefully by this point you've watched the previous 2 tax episodes we've done with Joe from Myna. The first one was on really why you need to care about crypto taxes, and the second one was to help you in terms of what are basic crypto taxable events. Now, as you probably know, the world of DeFi has exploded in the last few months, and with that have become lots of opportunities for different forms of investment. They, however, I'm sure come with, a bit of a tax headache because it's moving quicker than perhaps HMRC can keep up with. So, going to have a chat to Joe today to talk about that. So, Joe, are you with us?
Hi, yeah, good to be back again, Ash.
Good to see you. So DeFi, incredibly sort of opportunistic time. Obviously we have things, like farming, staking, kind of NFTs with earning. Where do people who are trying to get a handle in this world, perhaps making a good whack of money through APYs, where do they start in terms of keeping track of it all?
Yeah, I mean, it's a really, as you kind of alluded to, it's a really challenging space at the moment because HMRC aren't moving quick enough with the way that the ecosystem is moving. So there isn't a huge amount of guidance around the DeFi space. And I think the other point to that is, KYC, there's not a lot of KYC being done in the DeFi space. And I think that probably concerns HMRC from one aspect. So yeah, at the moment, from my perspective, we've got to apply the rules in the best way that we possibly can. And we can go through those in a second as to how we feel that they should be applied from a best guess type of way.
I think looking at it from maybe a sort of use case point of view. So say I've decided I want to get into farming and I've got a bunch of Ethereum and a bunch of the other token that I'm going to combine together to earn interest. A lot of these are offering really good APYs compared to traditional banking, incredibly good APYs. Obviously some are crazy, and be careful, there are a lot of rug pulls in this space and a lot of danger out there. But say I've decided I'm going to earn 7% a month APY from combining my Ethereum X token together to create LP tokens, which is what you make when you put the two together. I've started earning that. It's on a decentralized platform. Like you say, there's no KYC. There's no way of really tracking it using software like ACCOINTING or anything like that because it is still a little bit Wild West. What's the best way to protect ourselves going forward to monitor this?
So from my perspective, it comes back to what we said in an earlier episode, which is planning ahead and thinking about what you're doing. The majority of people out there do want to do the right thing by their tax implications and whatnot. So if you are that way inclined to make your life and our life significantly easier, plan. So keep a record. If you can't get exports, then keep your own export. When you make a trade or when you, put those tokens together to add to a pool, then create your own spreadsheet database, because the challenge at the moment is getting the data out of these systems, and that it's not just the data coming out that you might think, well, I haven't been KYC'd, so what's the issue if I don't put it on my tax return? But the other side of this is at some point you'll realize some of that money into a probably centralized exchange in order to get that off the exchange and into your bank account. And it's at that point you say, well, how did I get that money into that position in the first place? So, trying to wind all that back up, it's all great when you're making the gains and the interest and all's going well. But as soon as you want to offer up that money into your bank account, that's when you're going to come unstuck. So just keep planning ahead, keep your own database and just make sure that you know what you did and why you did it.
Yeah, this is one thing that I've sort of realised this year is as I've started taking some profits into my traditional bank account, the first thing that happens is the phone call comes in. Where has this money come from? We're seeing a difference in your income now. Can you please... Now, it's relatively simple for us because we bought some assets on Coinbase in 2017 and we have a record of those and we sold those. But obviously for people who are into a dizzying amount of DeFi trades, their argument would be, well, look, there's no KYC. There is no, AML stuff on this. And I understand your point there. It's kind of, people obviously want to, if they get their head screwed on, they want to pay tax, but they don't want to pay more than they have to. But the point I think you're making, which I really sort of stand by too, is a lot of people haven't thought about the sort of legacy of where this money comes from. And sooner or later, if it becomes a sizable amount, you're going to get asked to prove the legitimacy of where that came from. Now, obviously at the moment, wallet addresses aren't KYC'd. Some people I know have got 20 different Ethereum wallets with stuff banging around all over the place. Assuming, they do keep records of that, HMRC has no way of accessing people's wallet addresses at this point, do they? So it's on the person to keep track of it, presumably.
Yeah, I mean, ultimately HMRC don't have the power to look at anyone's personal data without request, right? So the thing where people think, oh, well, can they see this? They can't see a centralized network the same way they can't see your wallet. The difference being is with a centralized network like Coinbase, when they've signed up to an IPO, I'd be stunned if they didn't sign up some kind of deal with the American tax authority to say that they would disclose information where required. So it's the same with your bank account. HMRC can't just dive into your bank account without it's your bank account, it's your money. But the difference being here is the wallet is kind of personal and like off chain, if you like. It's not off chain, obviously it's all part of the blockchain, but just it's kind of it's away from the kind of the centralized public eye. So even if HMRC said we now have the right to look at your wallet, they wouldn't have the means to be able to do that. Whereas with the centralized networks, they could, if there was a law passed, they could then just ask that centralized network to provide the information to them. So like I say, the difference there is not so much that they can or can't, it's whether they're allowed to or not in certain circumstances. So just be wary of that at some point, like you just said, you're going to want to withdraw that money. And we've had a few occasions where people have wanted to purchase houses because they've done so well. And even the lawyers are saying, where's that money come from? Show me the trail of funds to getting to this point. And the last thing you want when you're just about to buy your dream home after you've made your millions in crypto is to then find you can't buy it because you can't prove where your money came from. So it's not just about tax. And if I may just quickly ask as well, like, the key here is you hit the nail on the head. It's about not paying too much. And if we can't prove where the money's come from, we can't prove a cost base or anything like that, then you could end up paying significantly more in tax than you need to. So it's not just about let's declare all this money and pay the tax. It's about let's make sure you only pay what you have to and nothing more.
Tax planning. So it's not show me the money, it's show me where the money came from. I love it. It's hard enough to make money in crypto as it is, right? So if by the time I always think of it like fishing. You go out, deep sea fishing, difficult waters, you land the fish, can you get it in the boat? Even when you get it in the boat, you've got to get the boat back and get the fish off the boat, then you've got to sell it at market. So I think, the lesson we're learning from all of these conversations is even if it isn't KYC and all the rest of it, keep records, because you're not going to be able to remember this stuff in 2 years' time if you've gone through 100 different coins and liquidity pools. If you need to provide that information, it's better to have it and not need it than need it and not have it.
Yeah, 100%. And as I'm sure you well know, trying to go back and understand what you've done in this space when you've transferred, like you say, between 15 different pools with 17 different tokens, all in the space of 5 minutes, trying to work out what you've done and where it's gone. And that's the problem, is if you can't chain it all together, you'll never get to the end point. So even one break in that chain is going to cause you an issue. So yeah, 100%, just keep ahead of the game and for your own sake as well, plan, because you then at least know where all that money's gone and where it's gone and how much money you have or haven't made, et cetera, et cetera. So it's not just from a tax perspective, from a personal financial planning perspective, you want to know where all your money's moved to and from.
And also, I guess one thing we haven't talked about, but just very quickly, is obviously if you are doing a lot of this kind of activity, Ethereum fees are extortionately expensive. So the other side is that's a cost of business, right? But I wouldn't know how to, I know you can go, I went once and looked on the ETH fees to see how much I'd spent, and it was such a disgustingly high figure, I sort of felt sick and closed the window. But how do you, I guess you could also bring that in as a cost of business against your tax, right?
Yeah, precisely, and that's that's another key, really important point you just noted there, is that these fees are or can be quite high in certain areas, and if you're paying those fees, you want to make damn sure that you get some kind of credit back for paying those fees. So yeah, again, trying to keep a record of how much it costs you to move this money around is really important, and it all comes back nicely to that planning point and to that thinking ahead. And even like you just said, even if you've got the information but you don't ever need to use it, that's a significantly better position than trying to go back 1, 2, 3 years and trying to understand what you've done. So yeah, just plan ahead is I'm going to keep reiterating that.
Great. Well, look, thanks for joining us today. We're going to be back for the fourth and final part where we'll talk about how you can track this stuff and a little bit of a summary. But until then, thanks very much for joining us today.
Thanks, Ash. Great to see you again.